Before we begin, a quick and important disclaimer. The information presented in this video is strictly for educational and entertainment purposes only and does not constitute professional, legal, financial, tax, or real estate advice. Divorce, family law, asset division, and the dissolution of a marital estate are incredibly complex and highly localized legal processes that vary significantly drastically from state to state, county to county, and even courtroom to courtroom. The financial concepts, procedural strategies, and case studies discussed in this masterclass, particularly those concerning real estate valuation, retirement account division, and tax liabilities, are meant to illustrate potential outcomes and historical trends. They are not a substitute for retained legal counsel or certified financial planning. Navigating the legal system, especially regarding uncontested or procedural filings, often associated with legal document preparation services, carries inherent risks. Any misstep in filing, failure to disclose assets, or misunderstanding of jurisdictional laws can result in severe and irreversible financial consequences. You must conduct your own thorough due diligence and consult with licensed family law attorneys, certified public accountants, and financial advisors in your specific jurisdiction before making any legal or financial decisions regarding your marriage, your assets, or your future. Right now, a silent wealth transfer catastrophe is unfolding across the fastest-growing region in the United States, and it is entirely legal. Over the past 6 years, the American Sun Belt, stretching from the booming tech corridors of California through the sprawling suburbs of Arizona, Texas, and down into the retirement havens of Florida, has witnessed one of the most massive demographic and economic shifts in modern history. Millions of families relocated, driven by the promise of lower taxes, better weather, and a real estate market that seemingly only went up. But beneath the surface of skyrocketing home equity and booming localized economies, a sociological pressure cooker has been quietly building. We are now seeing an unprecedented surge in marital dissolutions in these exact hypergrowth markets. But these are not your standard, run-of-the-mill separations. What happens when the streamlined, cost-effective, uncontested divorce process, often referred to in procedural circles and legal document preparation hubs as the 661 approach, collides head-on with a complex, hyperinflated Sunbelt marital estate? The results are often financially devastating. Consider a historical trend that has rapidly accelerated in the post-pandemic landscape. A couple relocates to a Sunbelt hotspot, purchasing a sprawling property in 2019 with a historically low 3% mortgage interest rate. Over the next 5 years, their localized market explodes. Their home value doubles. Their localized investment portfolios, tied to regional economic booms, swell. On paper, they have achieved the American dream. But as the marriage fractures, they decide to pursue what they believe will be a simple, amicable, uncontested divorce to save money on exorbitant attorney fees. They seek out streamlined legal document preparation, assuming their mutual agreement on the kitchen table is enough to untangle a web of highly complex financial assets. They fill out the localized paperwork, sign the marital settlement agreement, and submit it to the courts. Feels like a victory. It feels like they have successfully navigated the system, bypassing the traditional adversarial bloodbath of litigation. But within months, the unseen traps spring shut. Because they utilized a purely procedural approach without understanding the deep substantive nuances of Sunbelt state laws, they failed to account for the catastrophic tax implications of liquidating a joint brokerage account to equalize a property buyout. They failed to realize that their golden 3% mortgage could not simply be transferred to one spouse without triggering a total refinance at a punishing 7% rate, rendering the home completely unaffordable for the spouse who kept it. They completely overlooked the necessity of a qualified domestic relations order, or QDRO, leaving hundreds of thousands of dollars in a 401k legally inaccessible and subject to massive early withdrawal penalties. And perhaps most devastatingly, they misunderstood the profound differences between community property states like California and Texas versus equitable distribution states like Florida. They thought they were saving $20,000 in legal fees, but their lack of deep procedural knowledge cost them $500,000 in lost equity, tax penalties, and destroyed credit. This is not an isolated incident. This is a systemic vulnerability affecting thousands of households across the southern United States right now. The infrastructure of the uncontested divorce industry is designed for efficiency and procedural compliance, not for complex financial defense. It operates as a powerful tool, but a tool that requires the user to possess a master-level understanding of what they are actually building. The open loop that traps so many is the illusion of simplicity. The forms are just paper, but the numbers written on them dictate the entire trajectory of your financial future. How do you actually utilize streamlined legal preparation without stepping on financial landmines? How do you equalize a hyperinflated Sun Belt real estate asset when neither party has the liquid cash to buy the other out? And what are the hidden predatory strategies that one spouse might quietly deploy during an supposedly amicable mediation to secure a drastically disproportionate share of the marital wealth? This masterclass is designed to solve exactly that problem for the American audience facing the daunting prospect of marital dissolution in today's volatile economic climate. If you are living in the Sun Belt, or any region experiencing massive real estate fluctuations, and you are contemplating the end of a marriage, the information in this series is the absolute baseline of what you must understand to protect your livelihood. We are going to completely deconstruct the mechanics of the modern divorce, stripping away the emotional chaos to focus purely on the tactical, financial, and procedural reality of the process. You are going to learn the historical trends of asset division, the critical difference between legal strategy and legal procedure, and the step-by-step mechanisms of how wealth is legally partitioned. We will explore detailed case studies of how standard marital settlement agreements frequently fail when exposed to the stress tests of IRS regulations and state-specific property laws. You will learn how to accurately assess the true, long-term value of an asset, looking far beyond its current market appraisal to understand its future tax burden and liquidity. We will dissect the strategic deployment of mediation, the precise moments when an uncontested approach is viable, and the red flags that indicate a supposedly simple 661-style procedural filing is actually a catastrophic mistake for your specific financial profile. The problem you face today is an asymmetry of information. The legal system, the tax code, and the economic reality of the Sun Belt are aligned against the uninformed. By the end of this deep dive, you will possess the comprehensive framework required to approach this complex transition not as a victim of the system, but as an informed, strategic participant capable of safeguarding the assets you have spent a lifetime building. To understand exactly how these assets are dismantled, we must first look at the very foundation of the Sun Belt wealth trap, which is the family home. In the current landscape of the year 2026, real estate is not just a place of residence. It is the primary vessel of accumulated wealth for the vast majority of American families. But real estate equity is illiquid, heavily taxed under certain conditions, and legally tethered to highly restrictive lending covenants. When couples attempt to navigate the dissolution of their marriage using simplified procedural tracks, they frequently conflate the concept of ownership with the concept of liability. This fundamental misunderstanding is where generational wealth is completely obliterated. Imagine if a couple, let us call them David and Jessica, relocated to Phoenix, Arizona in the year 2019. They purchased a single-family home for $400,000, securing a 30-year fixed-rate mortgage at a historically low 3% interest rate. Fast forward to the year 2026. The localized market has experienced a massive influx of out-of-state buyers, pushing the appraised value of their property to $900,000. They now possess $500,000 in raw unrealized equity. The marriage breaks down and they agree to an amicable separation. Driven by the desire to minimize legal expenses, they utilize a legal document preparation service, opting for a streamlined procedural filing to divide their assets. Their agreement seems perfectly balanced on the surface. Jessica wants to maintain stability for their children and stay in the home. David wants his $250,000 share of the equity, so he can purchase a new property and start fresh in Dallas, Texas. They draft a seemingly straightforward marital settlement agreement. Jessica will keep the house and assume the mortgage. In exchange, she will transfer $250,000 from their joint brokerage account to David to buy out his half of the equity. They sign the paperwork, submit it to the county clerk, and a judge signs the final decree. They believe they have successfully utilized the system. Instead, historical trends and numerous case studies reveal that they have just triggered a devastating financial collapse for both parties. Let us break down the exact mechanics of why this supposedly equitable agreement is fundamentally flawed. First, we must address the mortgage trap. Jessica assumed that because the divorce decree awarded her the house, she could simply take over the existing 3% mortgage. However, mortgage lenders are not bound by family court decrees. The lender holds a contract with both David and Jessica. Under standard conventional loan terms in 2026, mortgages are rarely assumable without an exhaustive underwriting process that most single-income divorced spouses fail to pass. The bank demands a complete refinance to remove David from the financial obligation. Jessica must now qualify for a new loan at the prevailing 2026 interest rates, which are significantly higher than her original 3% rate. Her monthly housing expense suddenly skyrockets, completely destabilizing her post-divorce budget. But the situation is equally perilous if the bank refuses the refinance and Jessica simply stays in the home while making the current payments. In this scenario, David agrees to sign a quitclaim deed, transferring his ownership rights entirely to Jessica. He assumes he is free and clear. This is the most common and dangerous misconception in procedural divorces. A quitclaim deed only transfers the title of the property. It does absolutely nothing to sever the financial liability of the mortgage. David is no longer the legal owner of the house, but his name remains firmly attached to the debt. When David moves to Dallas, Texas and applies for a new mortgage, the underwriter will pull his credit report and see the massive Phoenix mortgage still factored into his debt-to-income ratio. He will be denied the new loan. Furthermore, if Jessica suffers a financial hardship and misses a single mortgage payment, David will experience a catastrophic drop in his credit score, severely damaging his financial standing despite having zero legal right to the property he is being penalized for. The financial destruction deepens when we examine the mechanism Jessica used to pay David for his equity. She liquidated $250,000 from their joint brokerage account. By selling those localized investments and index funds, she inadvertently triggered a massive capital gains tax event. The Internal Revenue Service views the sale of those securities as a taxable realization of profit. Jessica is now solely responsible for tens of thousands of dollars in federal and potentially state capital gains taxes. Meanwhile, David receives his $250,000 buyout entirely tax-free. Because transfers of property directly related to a divorce settlement are generally protected under Section 1041 of the Internal Revenue Code. By failing to understand the deep substantive tax implications of their asset division, Jessica effectively transferred a massive portion of her actual net worth directly to the federal government, while David walked away with pure, unencumbered liquidity. This asymmetry of outcome is the direct result of applying a generic procedural mechanism to a highly complex financial ecosystem. And this complexity scales exponentially when we cross state lines within the Sun Belt. Consider the potential outcomes for a couple going through this exact same process in Miami, Florida versus Austin, Texas. Texas operates under community property laws, where assets acquired during the marriage are generally presumed to be owned equally by both spouses. Florida, however, is an equitable distribution state. Equitable does not mean equal. It means what the court deems fair based on a multitude of statutory factors. Imagine if a spouse in Florida built a highly lucrative regional logistics business during the marriage. If they attempt a procedural divorce without a forensic business valuation, the other spouse might assume they are entitled to a flat 50% of the company revenue. But in an equitable distribution state, the court carefully distinguishes between active appreciation, which is the value added through the direct labor of the spouse running the business, and passive appreciation, which is driven by general market forces. The court also separates enterprise goodwill from personal goodwill. If the entire value of the logistics business is tied strictly to the personal relationships and unique skills of the founding spouse, that personal goodwill may not be considered a divisible marital asset at all. A spouse relying on a basic document preparation template will completely miss this critical distinction, potentially walking away from hundreds of thousands of dollars they are legally entitled to, or conversely, paying out massive sums they were legally protected from relinquishing. Real estate and localized business valuations are only the surface layer of the Sun Belt divorce trap. The true complexity and the area where the most devastating financial errors occur during uncontested procedural filings lies in an asset class that is almost completely invisible on a standard balance sheet. It is an asset heavily regulated by federal law, governed by draconian tax penalties, and completely immune to standard marital settlement agreements. Even if you manage to perfectly navigate the real estate refinance, and even if you flawlessly execute a business valuation, your entire financial future remains in jeopardy until you understand the exact mechanism required to unlock the largest pool of hidden wealth in the modern American marriage. That hidden wealth, often dwarfing even the inflated value of a primary residence, is locked tightly inside employer-sponsored retirement accounts. In the year 2026, the average affluent household residing in the corporate hubs of the Sun Belt holds significantly more capital in 401k plans, pensions, and defined benefit plans than they possess in liquid cash or home equity. Yet, when couples attempt a streamlined, uncontested procedural filing to dissolve their marriage, They treat these highly regulated federal accounts with the exact same casual approach they use to divide a shared checking account. This is a catastrophic error. A standard marital settlement agreement, even when signed by a state family court judge, is completely powerless to divide an employer-sponsored retirement plan. To understand why, we must look at the federal law that governs these accounts, known as the Employee Retirement Income Security Act, or ERISA. Under ERISA regulations, a plan administrator is legally prohibited from distributing funds to anyone other than the employee who earned them. The only legal key capable of unlocking an ERISA-governed account and transferring funds to a non-employee spouse without triggering a massive tax penalty is a highly specialized, separate legal document called a Qualified Domestic Relations Order, universally referred to as a QDRO. Imagine if we look at a case study involving a couple, Michael and Sarah, living in Charlotte, North Carolina in 2026. Michael has spent 15 years working as an executive for a major regional banking institution, accumulating a 401k balance of $1.2 million. Sarah and Michael decide to separate amicably. They use an online legal document preparation service to draft their settlement. They agree to split the retirement account right down the middle. Their final divorce decree explicitly states that Sarah is awarded $600,000 from Michael's 401k. The state judge signs the decree, and the divorce is finalized. They believe the process is over. A few weeks later, Sarah contacts the 401k plan administrator, sends them the signed divorce decree, and asks for her $600,000. The administrator flatly denies her request. They explain that a state divorce decree does not override federal ERISA law, and without a QDRO, they cannot release a single cent to her. Panic sets in. Michael, trying to be cooperative and honor their agreement, decides to take matters into his own hands. He logs into his retirement portal and initiates a personal withdrawal of $600,000, planning to simply wire the cash to Sarah's checking account so they can both move on with their lives. By executing that withdrawal, Michael has just triggered a financial nightmare of historic proportions. Because he is under the age of 59 and a half, the Internal Revenue Service immediately assesses a 10% early withdrawal penalty on the entire amount, instantly vaporizing $60,000. Furthermore, the remaining $540,000 is now classified as standard taxable income for the year 2026. This massive artificial income spike pushes Michael into the absolute highest federal and state tax brackets. By the time the federal government and the state of North Carolina take their share, the original $600,000 is reduced to roughly $300,000. Michael is now legally obligated by the state court decree to pay Sarah $600,000, but he only netted half that amount from the withdrawal, leaving him personally liable for a massive shortfall he cannot possibly afford. This catastrophic scenario happens entirely because the couple relied on a generic procedural framework and failed to understand the exact step-by-step mechanism of a QDRO. The correct procedure requires drafting the QDRO concurrently with the divorce settlement. This document must be painstakingly tailored to match the specific, idiosyncratic rules of Michael's specific employer plan. Once drafted, it must be submitted to the plan administrator for pre-approval before it ever goes to a judge. This pre-approval process alone can take months. Only after the corporate legal department signs off on the language can the QDRO be submitted to the family court judge for a signature, and then finally returned to the plan administrator for execution. When executed correctly, the QDRO orders the creation of a separate subaccount within the 401k for Sarah. The $600,000 rolls over into her new account completely tax-free. No early withdrawal penalties are triggered, and no taxable income is recognized until Sarah chooses to retire and draw from the funds years down the line. The QDRO acts as an invisible shield against the IRS, but a standard procedural document preparation service rarely includes the drafting of this highly complex, federally compliant order. Furthermore, the timing mechanics of this division introduce severe market vulnerability. Let us return to Michael and Sarah. Suppose they actually realize they need a QDRO, but they finalize their divorce in January and delay drafting the QDRO until June. They agree to split the $1.2 million account equally based on the January balance. But what happens if the 2026 stock market experiences severe localized volatility, and by June the account has dropped in value to $900,000? Does Sarah still get her fixed $600,000, effectively leaving Michael with only $300,000? Or does Sarah get half of the new depleted balance, receiving only $450,000? If their procedural marital settlement agreement failed to specify exact language regarding the assignment of market gains and losses between the date of separation and the date of final distribution, they are trapped in a legal gray area. Historical trends show that this specific ambiguity is one of the leading causes of post-judgment litigation in Sunbelt jurisdictions. Spouses end up spending tens of thousands of dollars fighting in court over market fluctuations that occurred simply because they failed to properly draft a highly specific valuation date clause into their initial paperwork. The complexity compounds further when couples confuse employer-sponsored 401k plans with individual retirement accounts, or IRAs. While 401k plans require the exhaustive QDRO process, an IRA does not. To divide an IRA, you must utilize a completely different mechanism, known as a transfer incident to divorce under Section 408 of the Internal Revenue Code. If a couple mistakenly assumes an IRA needs a QDRO, they will waste months of time and thousands of dollars paying specialized attorneys to draft a document that the IRA custodian will ultimately reject as unnecessary. Conversely, if they assume a 401k can be divided with a simple letter of instruction like an IRA, they will fall right back into the early withdrawal tax trap. These are not mere clerical errors, they are foundational misunderstandings of how wealth is legally structured and partitioned in the modern era. The procedural track relies on the assumption that your financial life is simple. But if you have lived and worked in a hypergrowth Sunbelt economy for any significant period, your financial life is inherently complex. The legal document preparation industry provides the vehicle to end the marriage, but it does not provide the map to safely navigate the resulting financial unwinding. And yet, traditional retirement accounts, with all their federal regulations and tax complexities, are still highly visible on a standard financial affidavit. They are easy to spot, even if they are exceptionally difficult to divide. But what happens when the assets are not neatly sitting in a Vanguard or Fidelity account? What happens when a spouse's true wealth is tied up in unvested restricted stock units, specialized executive compensation packages, or deferred localized performance bonuses that do not officially exist yet? How are high-earning spouses legally masking these future windfalls during the mediation process? And what exact legal discovery mechanisms must you deploy to prevent the largest financial asset of your marriage from quietly vanishing before the ink on your divorce decree even dries? The mechanism required to prevent this vanishing act begins by understanding the fundamental difference between standard W-2 income and complex executive compensation, and why the streamlined procedural divorce track is structurally blind to the latter. In the rapidly expanding corporate hubs of the Sunbelt, from the Silicon Hills of Austin, Texas to the Research Triangle of North Carolina, the way professionals are compensated has fundamentally transformed. In the year 2026, base salary is often just a fraction of a high-earning spouse's actual economic footprint. The true wealth is entirely heavily concentrated in restricted stock units, commonly known as RSUs, specialized stock options, performance shares, and non-qualified deferred compensation plans. These are assets that do not exist as liquid cash in a joint checking account. They do not appear on a standard property deed. Often, they do not even trigger a taxable event that would show up on a recent tax return. They exist strictly as contractual promises of future wealth, housed in secure employer portals that only the employee spouse has the legal credential to access. Imagine if a couple, let us call them Thomas and Emily, are navigating a divorce in Austin, Texas in the year 2026. Thomas is a senior engineering director who was recruited by a major tech conglomerate 3 years ago. As part of his signing package, he was awarded RSUs that vest over a 4-year period. Emily and Thomas decide to pursue an uncontested, streamlined dissolution of their marriage. They want to avoid the adversarial court system, so they mutually agree to use a legal document preparation service, effectively utilizing a standard 661-style procedural approach. As part of this process, they are required to exchange financial affidavits, essentially filling out standardized forms listing their respective incomes, bank account balances, and debts. Thomas prints out his most recent pay stubs, his W-2 from the previous year, and the current balance of their joint savings account. Everything appears transparent. Based on the documentation Thomas provides, Emily agrees to a modest settlement, believing she is receiving an equitable half of their actual marital estate. What Emily does not know, because the procedural framework did not actively force the discovery of it, is that Thomas has an unvested RSU grant currently valued at $800,000 based on the current 2026 stock price of his company. Because these shares are unvested, meaning Thomas has not yet met the time requirement to officially take ownership of them. They are not reported as current income. They do not show up on his W-2. They are functionally invisible to the standardized forms used in a basic legal preparation service. Thomas might rationalize this omission by telling himself that the stock is not truly his yet, and therefore it is not a marital asset. But historical trends in family law, particularly in community property states like Texas, dictate a very different reality. Under the law, compensation earned during the marriage, even if it is paid out or vests in the future, is generally considered a divisible marital asset. The courts utilize complex formulas, often referred to conceptually as time rules, to determine exactly what percentage of that unvested $800,000 was generated by labor performed during the marriage versus labor that will be performed after the date of separation. A significant portion of those unvested shares legally belongs to the marital estate. But because Emily relied on the voluntary disclosure inherent in a procedural divorce, she completely waived her right to uncover this wealth. She walked away from hundreds of thousands of dollars simply because she did not know the right questions to ask, and the forms she filled out were not designed to ask them for her. The fatal flaw of the uncontested procedural track in high-asset Sunbelt divorces is its absolute reliance on the honor system. It operates on the presumption of complete, voluntary financial transparency between two people whose relationship is inherently fracturing. When you opt into a streamlined process to save on legal fees, you are almost always required to sign a waiver of formal discovery. Legal discovery is the compulsory, court-mandated process of gathering evidence. It is the tactical deployment of subpoenas, interrogatories, and requests for production of documents. When you waive discovery, you surrender your legal authority to demand documents directly from your spouse's employer. You surrender your right to place your spouse under oath in a deposition and force them to answer forensic questions about their deferred compensation packages. If Emily had utilized formal discovery, rather than accepting a streamlined procedural waiver, her legal representation would not have relied on Thomas handing over a printed pay stub. Instead, they would have issued a subpoena dutes tecum directly to the human resources and payroll departments of the tech conglomerate Thomas works for. This legal directive forces the employer, under penalty of law, to produce the exact grant agreements, the comprehensive vesting schedules, and the complete history of all stock options awarded to Thomas since his date of hire. It bypasses the spouse entirely, securing raw, unalterable data straight from the source. The necessity of this mechanism becomes even more critical when dealing with deferred compensation. In the year 2026, highly compensated executives often utilize non-qualified deferred compensation plans to strategically delay the receipt of their bonuses or salary to future years, specifically to lower their immediate tax burden. A spouse could legally elect to defer 50% of their massive annual performance bonus into a corporate trust that pays out 5 years from now. If you are relying on their current tax return or their current bank statements during a simplified mediation, that deferred wealth is completely invisible. It is legally masked. Only through aggressive, targeted formal discovery, specifically requesting the employer's deferred compensation plan documents and the employee's deferral election forms, can this hidden silo of marital wealth be exposed and rightfully divided. The tragedy of the modern Sun Belt wealth transfer is that individuals spend decades building massive economic security, only to legally sign it away in a matter of weeks because they prioritize the speed and perceived affordability of a generic paperwork filing over the meticulous, albeit adversarial, process of financial forensic extraction. They trade their financial future for the illusion of an amicable settlement. But uncovering the assets is only the first battle. Once the hidden wealth is exposed, or even if it remains successfully masked, the true danger shifts to the negotiation table itself. The procedural framework frequently pushes couples into mediation, framing it as a peaceful alternative to a trial. But what happens when the high-earning spouse weaponizes that very mediation room, utilizing devastating psychological tactics and the threat of catastrophic legal fees to force you into accepting a severely compromised settlement before you even have the chance to understand the true value of your own marital estate? To understand how mediation is weaponized, we must first look at the structural reality of the Sun Belt legal system in 2026. Courts from Florida to California are facing historic backlogs, and judges are increasingly mandating mediation as a prerequisite to any trial date. This shift was intended to alleviate the burden on the judiciary, but in high-asset cases, it has created a localized environment where the less financially dominant spouse is often walking into a psychological ambush. When you enter a mediation room, you are stepping away from the cold, objective rules of evidence, and entering a space governed by negotiation theory and leverage. Imagine if we look at a couple named Robert and Sophia, who have spent the last 12 years in the high-stakes real estate market of Tampa, Florida. Robert is a commercial developer with a deep network of professional contacts and a mastery of high-pressure negotiation. Sophia has spent the marriage managing the household and supporting the family's social standing. As they move toward a divorce, they agree to use a private mediator to settle their affairs. Robert, knowing the exact pressure points to hit, begins a campaign of financial attrition months before they ever sit down at the table. He begins by making subtle, alarming comments about the state of their localized commercial portfolio. He speaks about the looming 2026 credit crunch, the rising vacancy rates in downtown Tampa, and the supposedly massive personal guarantees he has signed that could, in his words, wipe them out completely. By the time they reach mediation, Sophia is in a state of financial panic. This is the first weapon, the manufacture of artificial scarcity. Robert knows that in a mediation environment, the person who appears the most willing to walk away from the table holds all the power. During the session, Robert's legal team presents complex, jargon-heavy spreadsheets that categorize their assets into two groups: those with immediate value and those that are distressed or illiquid. They suggest that if Sophia wants the safety of the family home and a specific cash payout, she must waive her interest in his commercial projects, which they characterize as high-risk liabilities. Historical trends show that spouses in Sophia's position often succumb to what behavioral economists call loss aversion. She is so afraid of the potential outcome of being left with a bankrupt commercial estate that she overvalues the certainty of the immediate cash. Robert is effectively trading her a small guaranteed sum of money for a massive, unvetted stake in a commercial empire that might actually be on the verge of a historic windfall. Because they are in mediation and not a courtroom, no judge is there to verify the validity of Robert's financial gloom and doom projections. The mediator, whose job is to facilitate an agreement rather than to ensure an equitable one, may not challenge the lopsided nature of the deal, as long as both parties are willing to sign. The second weapon utilized in these high-stakes Sunbelt negotiations is the threat of the legal fees treadmill. In the year 2026, the cost of high-level matrimonial litigation in major metro areas has reached an all-time high. It is not uncommon for a fully litigated divorce involving forensic accountants and vocational experts to cost upwards of $200,000 per side. A high-earning spouse can use this reality as a bludgeon. They might explicitly or implicitly communicate that they have the liquid capital to fight for years, whereas the other spouse will have to borrow against their future settlement just to keep their attorney on retainer. Consider the potential outcome of this power dynamic. The lower-earning spouse is presented with a settlement offer that is objectively poor, perhaps 40% of what they are legally entitled to. But the alternative presented is a 3-year legal battle that will consume the remaining 60% of their potential award in attorney fees, leave them emotionally exhausted, and delay their ability to move on with their life. This is the classic mediation trap. The settlement isn't based on what is fair under the law, but on what is cheaper than the cost of a fight. In the Sunbelt's fast-paced economic environment, the time value of money becomes a leverage point that more frequently favors the spouse who already controls the marital cash flow. Furthermore, we must address the specific localized tactic of the exploding offer. In the year 2026, many seasoned negotiators in states like Georgia and Texas utilize a strategy where a settlement offer is made with a strictly enforced expiration date, sometimes as short as 24 hours. This is designed to bypass the analytical brain and trigger an emotional, fear-based response. The goal is to prevent the other spouse from taking the proposed agreement to an independent forensic accountant who could deconstruct the true value of the offer. If you are told that you can have $5 million today, but if you don't sign, the offer drops to $3 million tomorrow as they move to full-scale litigation, the psychological pressure is immense. But there is a counter-strategy that is rarely discussed in the brochures for streamlined procedural divorces. It is the concept of the shadow forensic audit. To survive a high-stakes Sunbelt mediation, you cannot walk into the room as a passive participant. You must have already completed a comprehensive reconstruction of the marital lifestyle. This involves more than just looking at bank statements. It requires a deep dive into the credit card spending patterns over a 3 to 5 year period. Why? Because the lifestyle is often the only honest indicator of the true income. Imagine if Robert's tax returns show a modest executive income of $250,000, yet the family is spending $600,000 a year on private schools, high-end travel, and property maintenance in Tampa. The math does not add up. A shadow forensic audit identifies this discrepancy before mediation begins. It provides Sophia with the objective data to say that either there are hidden offshore accounts, or the commercial business is paying for personal expenses in a way that artificially deflates the reported marital income. This data flips the leverage. Suddenly, Robert is the one who has to worry about the potential outcomes of a formal court-ordered audit or an IRS inquiry, and the settlement offer miraculously begins to align more closely with reality. However, even with the best financial data in the world, there is one area where mediation and procedural filings consistently fail to protect the long-term interests of Sun Belt families. It is an area that feels emotional but is rooted in cold, hard jurisdictional law. It concerns the most precious asset of all, the future of the children. In a region where people move every few years for career opportunities, the standard parenting plan templates found in procedural filing kits are a ticking time bomb. They assume your life in 2026 will look exactly like your life in 2030. But what happens when the high-earning spouse receives a massive promotion that requires a relocation to another state? What happens when the school district you agreed upon today becomes a ghost town tomorrow? The localized legal war for custody and relocation is where the true, long-term costs of a cheap divorce are finally paid, and the mechanisms of that conflict are more complex than most parents can possibly imagine. To understand the mechanism of the custody and relocation trap, we must first analyze the demographic volatility of the Sun Belt in the year 2026. This region is defined by mobility. Professionals are moving into cities like Nashville, Tennessee, Charleston, South Carolina, and Scottsdale, Arizona at record rates, often for high-paying corporate roles that require total geographical flexibility. When a couple enters a streamlined procedural divorce, they typically use a standard parenting plan template provided by the state. This template is designed for a static life. It assumes that both parents will remain in the same county, or at least the same school district for the next decade. But in the modern Sun Belt economy, that assumption is a dangerous fallacy. Imagine if we look at a case study involving a couple named Marcus and Olivia, living in the tech hub of Austin, Texas. They have 2 children, ages 5 and 7. In their 2026 uncontested divorce, they agree to a standard joint managing conservatorship, which is the Texas equivalent of joint legal custody. They decide on a 50-50 time-sharing schedule because they currently live only 10 minutes apart. Everything seems harmonious. They utilize a procedural filing service to save money, and their parenting plan is a basic, off-the-shelf document that lacks a specific, detailed geographic restriction clause. 2 years later, Marcus receives an executive-level offer from a semiconductor firm in Boise, Idaho. The salary increase is substantial, including the exact kind of RSU packages we discussed earlier. Marcus wants to take the children with him. Olivia, who has built her entire support network in Austin, is horrified. Because their original procedural divorce did not include a strictly defined geographic restriction, a legal mechanism that limits the primary residence of the children to a specific county or its contiguous counties, Marcus believes he has the right to relocate. Olivia is forced to file an emergency lawsuit to prevent the move. The potential outcomes of this lack of foresight are financially and emotionally draining. Olivia must now pay for an expensive legal battle that could have been avoided with a single, precisely drafted paragraph in her initial decree. The court must now apply the best interests of the child standard, a highly subjective legal test that considers the children's relationship with each parent, the quality of education in both Boise and Austin, and the impact of the move on the children's stability. In the year 2026, many Sunbelt judges are increasingly skeptical of relocation cases that sever the bond with the non-moving parent, but without a clear geographic restriction in the original paperwork, the burden of proof is much higher for the parent trying to stay. This highlights the critical importance of the domicile restriction clause. In a deep dive masterclass on Sunbelt divorce, you must understand that the primary parent is typically granted the exclusive right to determine the legal residence of the children, but a sophisticated decree will tether that right to a very small map. For example, a well-drafted 2026 Austin decree would state that the mother has the right to determine the residence of the children, provided that such residence is located within Travis County or Williamson County. This prevents the other parent from being blindsided by a move 3 states away. Standard procedural forms often leave this section blank or use dangerously broad language like the state of Texas, which allows a parent to move from Austin to El Paso, a 10-hour drive that effectively destroys a 50-50 parenting schedule. Furthermore, we must address the step-by-step reality of the multi-state jurisdictional nightmare, known as the UCCJEA, or the Uniform Child Custody Jurisdiction and Enforcement Act. This is the federal-level framework that determines which state has the power to make decisions about a child. Imagine if Marcus, in our Boise, Idaho scenario, decides to move anyway and files for custody in Idaho while Olivia is still fighting in Texas. Under the UCCJEA, the two judges from different states must actually get on a phone call with each other to determine which state is the home state of the child. This is a procedural labyrinth that can cost tens of thousands of dollars in interstate legal fees. Historical trends show that families who use simplified 661-style filings without considering future relocation are the most likely to end up trapped in these jurisdictional wars. Beyond relocation, the standard templates fail to account for the skyrocketing cost of a Sunbelt upbringing in 2026. Child support is calculated using state-mandated guidelines, which are typically a percentage of the paying parent's net monthly resources. In Texas, for 2 children, this is usually 25% of the first $9,200 of monthly income. However, these guidelines often fail to account for what is known as additional child support or extraordinary expenses. Think about the localized reality of living in a high-growth city like Charlotte, North Carolina, or Scottsdale, Arizona. The costs of private school tuition, elite club sports, specialized tutoring, and mental health services are not covered by a standard child support check. If your procedural decree simply says father shall pay $1,500 per month in child support, that is where his legal obligation ends. If your child is a ranked tennis player or needs intensive orthodontic work, the parent receiving the support has no legal mechanism to force the other parent to contribute to those specific costs, unless they were explicitly itemized in the decree. A sophisticated masterclass approach requires a step-by-step breakdown of the add-on expenses. You must negotiate a pro rata share of these costs based on each parent's income. If Marcus earns 70% of the total household income and Olivia earns 30%, the decree should specify that Marcus pays 70% of all agreed-upon extracurricular activities and unreimbursed medical expenses. Without this granularity, the lower-earning spouse, often the one who sacrificed career growth for the marriage, finds themselves in a state of perpetual financial crisis, even with a child support check coming in every month. We also have to consider the right of first refusal. This is a common clause in Sun Belt parenting plans that says if one parent is unable to be with the children for a specific period, usually 4 to 8 hours, they must offer the other parent the opportunity to watch the children before calling a babysitter or a grandparent. While this sounds like a great way to maximize parental time, in the year 2026, it is often weaponized as a tool of harassment. In a high-conflict divorce, a spouse might use this clause to monitor the other's social life, demanding to know exactly where they are and why they need a sitter. A generic procedural filing often includes this clause by default, but for many families, it creates more conflict than it solves. The long-term costs of a cheap divorce are not just found in the money you lose today, but in the lack of flexibility you have tomorrow. The Sunbelt economy moves fast, and your legal documents need to move even faster. But as complex as the custody and relocation issues are, they pale in comparison to the hidden liability that almost no one sees coming. It is the silent partner in every divorce, the entity that can swoop in years after the decree is signed and dismantle your financial recovery. We are talking about the ultimate variable that 661 filings almost never account for: the shifting landscape of federal and state tax liability for the newly single. How does the IRS view your Sunbelt property sale 3 years post-divorce? And why could your seemingly fair settlement trigger an audit that leaves you with nothing? To navigate the tax landscape of a Sunbelt divorce in 2026, one must look beyond the immediate division of assets and focus on the ticking time bombs hidden within the Internal Revenue Code. The central mechanism of this financial danger is the concept of basis carryover, a rule that often turns a seemingly equitable 50-50 split into a lopsided disaster once the tax authorities get involved. In the United States, Section 1041 of the Internal Revenue Code generally dictates that transfers of property between spouses or former spouses incident to a divorce are non-taxable events. This sounds like a protective shield, but in reality, it is a mechanism for deferring liability. When you receive an asset in a divorce, you do not just receive the current market value. You inherit the original cost basis. Imagine if we look at a couple named Brian and Chloe, living in the high-growth corridor of Nashville, Tennessee. During their 15-year marriage, they invested heavily in localized rental properties. One particular duplex was purchased in 2011 for $200,000. By the year 2026, due to the explosive growth of the Nashville market, That property is appraised at $1 million. In their streamlined, uncontested procedural divorce, Brian and Chloe agree to split their assets. Chloe takes the family home, and Brian takes the rental property. On the balance sheet they submitted to the court, the rental property is listed as having $1 million in value. Brian believes he has received an equitable share. However, the historical trends of tax litigation reveal Brian's critical error. Because of the basis carryover rule, Brian's cost basis in that property is still the original $200,000. When Brian decides to sell the property 2 years later to diversify his portfolio, the IRS does not see a zero-profit transaction. They see an $800,000 capital gain. Even with the current federal capital gains rates in Tennessee's specific tax climate, Brian is looking at a tax bill that could exceed $200,000. In contrast, if Chloe sells the primary residence, she may be eligible for the Section 121 exclusion, which allows a single filer to exclude up to $250,000 of gain on the sale of a principal residence. By failing to account for the latent tax liability attached to the rental property's basis, Brian effectively accepted an asset that was worth 20% less than its appraised value. This is the tax trap of the Sun Belt. In a market that has appreciated this rapidly, the gap between market value and tax-adjusted value is a chasm that swallows entire fortunes. Step by step, a sophisticated divorce strategy requires the calculation of the net after-tax value for every single asset. You cannot simply look at a bank statement or an appraisal. You must subtract the potential capital gains tax, the costs of sale, and any recapture of depreciation. For Brian in Nashville, a professional forensic analysis would have valued that $1 million rental property at roughly $780,000. This realization would have completely changed the negotiation, potentially leading Brian to demand additional liquid assets to offset the future tax burden he was inheriting. But because Brian used a generic 661-style procedural filing, the forms he used only asked for the fair market value, leaving him to pay the IRS for Chloe's half of the appreciation. Furthermore, we must address the complex and often misunderstood reality of filing status in the year of divorce. In the United States, your marital status for the entire tax year is determined by your status on the final day of that year, December 31st. This creates a high-stakes timing game. If a couple in a high-tax jurisdiction like California or a rapidly changing tax environment like Arizona finalizes their divorce on December 30th, they lose the ability to file a joint return for that entire year. For high-earning Sun Belt professionals, the jump from the married filing jointly brackets to the single filer brackets can result in a sudden, unexpected tax increase of tens of thousands of dollars. Imagine if Chloe and Brian had a combined income of $400,000. Filing jointly, they benefit from wider tax brackets and various deductions. If their procedural divorce is rushed through the court system in late December, they are suddenly forced to file as single. Not only does their tax rate spike, but they may also lose eligibility for certain credits or the ability to deduct specific localized investment losses. Historical trends show that many couples actually benefit from strategically delaying the final signature on their divorce decree until January 1st of the following year, purely to capture one final year of joint filing tax savings. Yet, a standard legal document preparation service will never prompt you to check with the CPA about the optimal date for your final decree. Another invisible liability involves the hidden history of the joint tax return itself. When you sign a joint return, you are manifesting what the IRS calls joint and several liability. This means the government can collect the entire tax debt from either spouse, regardless of who earned the income. In the Sun Belt, where many entrepreneurs and independent contractors operate, tax audits often occur 2 or 3 years after the return is filed. Imagine if, in 2026, Chloe and Brian are divorced and living separate lives. The IRS launches an audit into Brian's 2024 business expenses and determines he owes $50,000 in back taxes and penalties. Because they filed jointly in 2024, the IRS can legally seize Chloe's bank accounts or garnish her wages to satisfy Brian's debt. Even a perfectly drafted divorce decree stating that Brian is responsible for all past tax debts does not bind the IRS. They are not a party to your divorce. They will take the money from the easiest source available. While there are legal mechanisms like innocent spouse relief, the burden of proof is incredibly high and the legal fees to fight the IRS often exceed the tax debt itself. A procedural divorce provides no protection against this. A sophisticated masterclass approach, however, involves the inclusion of a comprehensive tax indemnification clause, and in some cases, the escrowing of funds specifically to cover potential future audits. We also have to look at the localized impact of state-specific tax changes in the Sun Belt. In 2026, several states are adjusting their treatment of alimony and separate maintenance payments. While federal law shifted in 2019 to make alimony non-deductible for the payer and non-taxable for the recipient, some states have not fully mirrored these changes or are introducing new localized levies on high net worth transfers. If you are moving between states during the divorce, a common occurrence in the Sun Belt, you could find yourself caught in a jurisdictional tax conflict where two different states claim the right to tax the same pool of marital support. The tax code is the ultimate silent partner in your divorce, and it never loses. By the time most people realize they have made a tax error in their 661 filing, the window for correction has closed, and the money is gone. But tax liability is only the first of the post-divorce financial shadows. There is another more systemic threat that targets your ability to even function in the 2026 economy. It is a threat that affects your ability to rent an apartment, buy a car, or even open a new business account in your new life. It is the hidden destruction of your credit identity through the mismanagement of joint debt, and the mechanisms used by creditors to hunt down former spouses are more aggressive today than ever before. How do you surgically untangle a decade of shared credit without triggering a total financial blacklisting? To surgically untangle a decade of shared credit in the high-stakes environment of the 2026 Sun Belt economy, you must first recognize that a divorce decree is not a magic wand that erases a contract with a third-party creditor. This is the most common point of failure for those utilizing a 661-style procedural filing. In the eyes of a major lender, such as a national bank or a credit card issuer, the private agreement between two former spouses is irrelevant. If your name is on a joint credit card, a car loan, or a home equity line of credit, you are 100% liable for the entire balance until that account is closed or refinanced. Imagine a case study involving a couple, Christopher and Sarah, living in the booming tech hub of Raleigh, North Carolina. During their 12-year marriage, they maintained a high-limit joint credit card used for household expenses and travel, as well as a joint auto loan for a luxury SUV. In their 2026 uncontested divorce, they agreed that Christopher would keep the SUV and be responsible for the remaining $20,000 on the loan. They also agreed to split the $15,000 balance on the joint credit card, with each paying half within 90 days. A judge signed their decree, and they felt their financial lives were successfully separated. 6 months later, Christopher, facing the increased cost of living in North Carolina and the higher interest rates of the 2026 market, begins to struggle. He misses 2 payments on the SUV. Sarah, who has since moved to an apartment and is trying to rebuild her savings, is blindsided when her credit score drops 80 points in a single month. She calls the lender, pointing to the divorce decree that clearly states Christopher is responsible for the loan. The lender's response is cold and consistent with historical trends. The decree is a contract between Sarah and Christopher, but the loan is a contract between Sarah, Christopher, and the bank. Because Sarah is still a co-signer, the bank has every legal right to report the late payments on her credit profile, and eventually, to pursue her for the full balance if Christopher defaults. This scenario represents the systemic destruction of credit identity. To avoid this, a masterclass approach requires a step-by-step liquidation of all joint debt before the final decree is signed. This is often difficult in the Sun Belt where assets are tied up in real estate equity, but it is a functional necessity. The mechanism for this is a zero-tolerance debt decoupling strategy. For credit cards, this means not just paying them off but officially closing the accounts. Many people mistakenly believe that removing a spouse as an authorized user is enough. In reality, if the account was opened as a joint account, both parties remain liable for life until the account is terminated. Step by step, you must conduct a comprehensive credit audit. In the year 2026, this involves pulling a 3-bureau credit report to identify every single account where both names appear. You might be surprised to find old retail cards or furniture financing accounts from the early years of the marriage that were forgotten but remain open. Each of these is a potential liability. Once identified, the settlement agreement must mandate the immediate closure of these accounts. If there is a balance that cannot be paid off instantly, the strategic move is to transfer the balance to a new individual credit card in the name of the spouse who is assuming the debt. This acts as a firebreak, protecting the other spouse's credit score from any future mismanagement. The auto loan presents a more complex procedural hurdle. In a high-interest environment, refinancing a car loan in 2026 can be expensive. If Christopher cannot qualify for a new loan in his own name at an affordable rate, Sarah remains in a position of extreme vulnerability. A sophisticated decree in this situation should include a default clause that triggers an immediate sale of the asset. For example, if Christopher is more than 15 days late on a payment, the decree could mandate that the SUV be surrendered to a neutral third party for sale, with the proceeds used to pay off the joint debt. Without this specific enforcement mechanism, Sarah is a financial hostage to Christopher's future choices. Furthermore, we must address the hidden danger of the HELOC, the home equity line of credit. In the Sun Belt, where home values have soared, many couples have large, open lines of credit attached to their primary residence. Imagine if Sarah kept the house and Christopher moved out, but they neglected to freeze the HELOC. Christopher, in a moment of financial desperation or out of spite, could potentially draw $50,000 from that line of credit. Because the account is joint, the bank will fund the request, and the debt will be secured by the equity in Sarah's home. Historical trends show that many 661 style filings completely overlook the need to provide a formal, written notice to the bank to freeze or close these lines of credit during the pendency of the divorce. Beyond the immediate risk of default, the mere existence of joint debt impacts your borrowing power. In the 2026 lending environment, banks use highly sensitive algorithms to calculate your debt-to-income ratio. If you are a co-signer on your ex-spouse's $60,000 truck loan, that entire $60,000 is counted against you when you apply for a new mortgage, even if your ex-spouse has never missed a payment. This can prevent a newly single person from qualifying for a home, effectively trapping them in a cycle of high-rent apartments despite having a significant settlement in the bank. The psychological impact of this financial tethering cannot be overstated. Financial separation is the prerequisite for emotional recovery. When you receive a notification that your ex-spouse just spent $400 at a high-end restaurant on a card that still has your name on it, the trauma of the marriage is reactivated. To prevent this, you must treat the untangling of credit as a clinical, high-stakes operation. This involves changing every password, updating every digital wallet, and even checking the autofill settings on shared computers. In the 2026 Sun Belt, where fintech and instant credit apps are ubiquitous, the number of digital touchpoints where your credit identity is linked to your spouse is staggering. Buy now, pay later services, subscription apps, and shared utility accounts all create a trail of shared liability. A procedural divorce filing simply does not have the granularity to address these modern complexities. But even if you successfully close every account and separate every loan, there is a final darker layer to the Sun Belt divorce that most people are completely unprepared for. It is the area where the legal system stops being about spreadsheets and starts being about the very core of your reputation and your professional standing. In a region where your network is your net worth, the way you manage the public-facing side of your divorce can be the difference between a successful second act and a total social and professional blacklisting. How do you protect your private life from becoming public record in an age of instant digital transparency and hyperlocal gossip? What are the specialized legal tools used by the elite to keep their 661 filings truly invisible to the outside world? To protect your private life from becoming a weapon of public destruction in the year 2026, you must understand that the American legal system is, by default, an open book. In the Sun Belt, where high-profile relocations and corporate transparency are at an all-time high, your divorce filing is not just a private disagreement. It is a public record accessible to any curious neighbor, competitive colleague, or predatory journalist with a smartphone and a credit card for court access fees. When you utilize a standard 661-style procedural filing, you are essentially uploading the intimate details of your financial failures, your parenting disputes, and your asset valuations into a searchable database. Imagine if we look at a case study involving a character named Alexander, a high-level executive at a leading aerospace firm in Orlando, Florida. Alexander and his spouse decide to pursue what they believe is a quiet, uncontested divorce using a streamlined online service. They fill out the standard financial affidavits, listing every bank account, their primary residence in a gated community, and Alexander's specific executive bonus structure. Because they are following the basic procedural track, these documents are filed directly with the county clerk. 3 months later, during a high-stakes contract negotiation at his firm, Alexander's professional rivals perform a simple background check and discover the full details of his divorce settlement. They see exactly how much liquid cash he has lost, the debt he has assumed, and the specific allegations of financial mismanagement that were buried in the boilerplate language of his marital settlement agreement. Alexander's leverage in his career is vaporized because his private life became a public liability. Historical trends in the Sun Belt show that the elite do not simply file for divorce. They utilize a sophisticated legal architecture designed to create a wall of digital privacy. The first and most powerful tool in this arsenal is the motion to seal the record. In most U.S. jurisdictions, including Florida, Texas, and Arizona, courts are extremely hesitant to seal an entire case because of the constitutional principle of public access to the courts. However, a masterclass level of legal strategy involves filing a targeted motion to seal specific, sensitive financial documents. Rather than asking to hide the whole divorce, Alexander's legal team would move to seal only the financial affidavits and the qualified domestic relations orders. This requires a specific showing that the public disclosure of these documents would cause a clearly defined injury, such as identity theft risk or the exposure of proprietary corporate trade secrets tied to his stock options. Step by step, the privacy-focused professional must also look into the strategic use of a private judge or an arbitrator. In the year 2026, many affluent Sunbelt couples are bypassing the public courthouse entirely by hiring a retired judge to preside over their case in a private law office. This is not just about speed, it is about the record. While the final decree must still be filed with the state to be legally binding, the vast majority of the discovery, the testimony, and the granular financial disputes remain in the private files of the arbitrator. This prevents the most salacious details of the marriage from ever entering the public electronic filing system. For an executive like Alexander, paying a private judge $500 an hour is a negligible cost compared to the potential outcome of a public scandal that could cost him a multi-million-dollar career. Furthermore, we must address the danger of the digital footprint left by the procedural service itself. Many low-cost online divorce platforms in 2026 operate on a business model of data aggregation. When you input your social security numbers, your children's birth dates, and your private account numbers into a third-party portal, you are trusting a private company with the keys to your entire financial identity. If that company suffers a data breach, your divorce details could end up on the dark web before your decree is even signed. A professional YouTube-level deep dive reveals that the safest way to maintain privacy is to utilize encrypted legal communication tools, and to ensure that all sensitive data is redacted from any document that is not legally required to contain it. In the Sun Belt, where personal branding is often tied to professional success, the reputation trap extends to social media. In 2026, AI-driven scrapers are used by insurance companies, future employers, and even mortgage lenders to analyze a person's social stability. If you are going through a 661-style divorce and you or your spouse are posting about it, even in private groups, you are creating a permanent record that can be used against you in future litigation or career moves. A sophisticated divorce strategy includes a mutual non-disparagement clause with a liquidated damages provision. This is a legal mechanism that says if either party speaks negatively about the other in a public forum, including social media, they must pay a preset financial penalty. This creates a powerful economic incentive to maintain a professional silence. Imagine if Alexander had included a $10,000 penalty for every social media post his spouse made regarding their private life. When emotions ran high, that clause would act as a psychological barrier, preventing the kind of public venting that often leads to career-ending viral moments. This is the difference between a reactive, emotional divorce and a strategic, professional dissolution of a partnership. But even with the best privacy tools and the most secretive filings, there is a final overarching reality that no amount of legal paperwork can fully suppress. It is the concept of the post-divorce audit, not by the IRS but by life itself. In the fast-paced economy of the Sun Belt, the version of you that emerges from the divorce must be capable of surviving the next 5 years of economic volatility. The biggest mistake people make in the final stages of a 661 filing is focusing so much on the past that they fail to build the infrastructure for their future. How do you transition from a dual-income power couple into a single-income financial entity without losing your status, your lifestyle, or your sanity? The final part of our masterclass will reveal the specific step-by-step rebuilding strategy used by high-net-worth individuals to reestablish their credit, resecure their assets, and launch their second act with more momentum than they had during their marriage. This is the part of the process that determines whether your divorce was a catastrophic end or a strategic pivot. We are going to look at the historical trends of successful post-divorce transitions and the one final legal maneuver that ensures your settlement is not just fair on paper, but enforceable in reality. If you think the hard part is over once the judge signs the paper, you are about to see the most critical phase of the entire 661 journey. The transition from a signed decree to a stabilized, independent life is where the theoretical division of assets meets the hard reality of the 2026 American economy. Most people assume that the entry of a final judgment is the finish line, but historical trends indicate that the first 18 months post-divorce are the most volatile for a newly single person's net worth. In the Sun Belt, where the cost of living and the speed of the market do not wait for you to find your footing, the rebuilding phase requires a clinical step-by-step re-entry into the financial system as a solo entity. This is the stage where you move from the defensive posture of litigation into the offensive posture of wealth reconstruction. Imagine if we look at a final case study involving a character named Jordan, a director-level professional in the healthcare sector of Atlanta, Georgia. Jordan has just finalized a streamlined 661-style divorce. The paperwork is filed, the assets are divided, and Jordan has moved into a new residence. On paper, Jordan is fine. However, the infrastructure of Jordan's previous life, the joint insurance policies, the shared estate plans, the linked digital subscriptions, and the combined emergency funds, has been completely dismantled. Jordan is now operating with half the capital but nearly 70% of the previous household expenses due to the loss of economies of scale. The first step in the post-divorce audit is the immediate execution of asset transfers. One of the most significant reasons why settlements fail in reality is the lack of follow-through. A divorce decree says you are entitled to half of a brokerage account, but it does not actually move the money. Jordan must now take the certified copy of the decree and work with a financial advisor to open an individual brokerage account and initiate the in-kind transfer of assets. If Jordan delays this by even a few months in a volatile 2026 market, the value of those assets could shift dramatically, or worse, the former spouse could inadvertently or intentionally draw down the balance before the transfer is initiated. Case studies show that a delay of just 90 days in executing asset transfers leads to a 40% increase in the likelihood of needing to return to court for enforcement actions. Furthermore, we must address the immediate necessity of an estate planning overhaul. In the year 2026, most states have laws that automatically revoke a former spouse's status as a beneficiary in a will upon divorce. But these laws are not universal and often do not apply to non-probate assets like life insurance policies or transfer-on-death bank accounts. If Jordan were to have a health crisis 6 months after the divorce, and the old estate plan was still in place, the former spouse might still hold the medical power of attorney or remain the primary beneficiary on a $2 million term life policy. This is a catastrophic oversight. The rebuilding strategy requires Jordan to draft a new will, designate new power of attorney agents, and update every single beneficiary designation across all financial platforms within the first 30 days of the final decree. Next is the strategic reconstruction of the credit profile. As we discussed in the credit section, Jordan's score may have taken a temporary hit during the separation. To qualify for the best localized mortgage rates or business loans in the high-growth Sun Belt, Jordan must aggressively re-establish individual credit depth. This involves opening a high-limit individual credit card, ensuring all utility and housing payments are in Jordan's name only, and utilizing credit builder tools that report timely rent payments to the bureaus. Historical trends suggest that a focused effort can restore a credit score to pre-divorce levels within 12 to 18 months, but only if the individual is proactive about removing themselves from the ex-spouse's lingering debt obligations. Then we must look at the insurance gap. In many Sun Belt marriages, one spouse provides the primary health and dental coverage through their employer. Upon divorce, the non-employee spouse loses that coverage, often facing the daunting prospect of COBRA premiums which, in 2026, can exceed $2,000 a month for a single individual. Jordan must evaluate the potential outcomes of the health insurance marketplace versus negotiating for a period of subsidized COBRA as part of the settlement. Additionally, the transition requires a new individual umbrella liability policy. In a litigious society, a newly single person with a significant settlement is a visible target. Protecting that settlement with a localized liability policy is a foundational move in the masterclass of financial defense. We also have to consider the emotional economic crossover. In the Sun Belt, where the social pressure to maintain a certain lifestyle is immense, many newly single individuals fall into the trap of revenge spending or trying to maintain a dual-income lifestyle on a single-income budget. The step-by-step rebuilding strategy involves a brutal ground-up budget reconstruction. Jordan must move away from the lifestyle inflation of the marriage and toward a lean, growth-oriented fiscal model. This often means downsizing the vehicle, reevaluating private school costs, or shifting from high-end leisure travel to localized, high-value experiences until the new financial foundation is solidified. The final and perhaps most critical legal maneuver in this entire journey is the creation of an enforcement file. A divorce decree is only as strong as your ability to enforce it. Jordan should maintain a meticulous log of all support payments, all parenting time exchanges, and all communications regarding the children. In 2026, there are specialized apps designed specifically for high-conflict co-parenting that timestamp and geolocate every interaction. If the former spouse begins to deviate from the court-ordered schedule or misses a support payment, Jordan has a ready-made evidentiary package for an enforcement motion. Being prepared for the potential outcome of a post-judgment dispute is the best way to prevent one from ever happening. The 661 journey is not a simple procedural event. It is a total systemic transition. By moving through this deep dive masterclass, you have seen the hidden tax liabilities, the complex federal retirement laws, the psychological warfare of mediation, and the digital privacy traps of the modern age. You now understand that the goal is not just to be divorced, but to be protected, liquidated, and positioned for a future that is entirely under your own control. The Sun Belt offers immense opportunity for those who can navigate its complexity. The end of a marriage is a significant ending, yes, but for the informed and strategic individual, it is the most powerful moment for a clean sheet redesign of their entire life. As you close this chapter and begin the work of your new life, remember that the legal forms are just the beginning. The real work happens in the spreadsheets, the bank meetings, and the daily decisions to prioritize your future over your past. You have the tools, the case studies, and the procedural framework. Now it is time to execute. This concludes our deep dive masterclass on the reality of the 661 process in the American Sun Belt. Stay focused, stay strategic, and always protect the assets you have worked a lifetime to build. Your second act starts now.